Thank you, everybody. So today we're going to be talking about factor strategy and market cycles. So I'm lucky enough to be the last one because I can leverage on my colleagues' work. You're going to hear about some of the equity factors that were considered by Johanny, so like momentum, value, quality. And I'm going to be talking about some more macro type of factors, like the ones that Jim just introduced to you, carry, value, and trend following. And my focus today is about market cycles. I'm going to make a big point about how market cycles can impact factor strategies' performances and how you can use and just look at what's happening in the market to try to make sense of what might be happening to your factor strategies. So let me start with the motivations and perhaps set up what's the problem. So factor strategies are about really tilting and assigning your portfolio to persistent driver of returns. So you're thinking you're capturing some sort of excess returns. And they have a couple of other characteristics. The first one is about that they are uncorrelated amongst themselves. So that means you want to have many of them, and they can make a good contribution to your traditional portfolio. And the second observation is that they are uncorrelated with the underlying markets. That means it's not just repackaging beta, they're offering you some unique new source of excess returns. Now, that's tricky, because when you read about that, you say, okay, that's great, they're uncorrelated with the market. But that doesn't say what you should expect from factor strategy with respect to markets. Sometimes you see factor strategies do poorly when the markets are up, and you say, well, why am I paying for those? The markets are up, so easy, let me buy the market. Sometimes they are down when the markets are down, and you think, wait, how this diversification works? I thought that would protect me when the markets wouldn't do so well. What I want to emphasize here is that all of these things can happen with factor strategies. That doesn't mean you should shy away from factor strategy, and I'm going to make this point fairly clear. And to make my point, I'm going to be looking at three types of market cycles. The first type of market cycle is very sharp. It's very brief. Let's call them bear markets. I'm going to be focusing on major drawdowns of the S&P 500 and look at how factor strategy performed during those times. Then I'm going to open up a little bit the horizons. So I'm going to be looking at market cyclical fluctuations, similar to business cycles. We are going to be looking at ups and downs of the stock market. And lastly, I'm going to hint at potential secular changes, big evolutions perhaps that are taking place in the markets. My colleague Johanny hinted at that before with the fact that the stock market has enjoyed over the last 30 years a pretty spectacular run. And I'm going to be talking about that as well. So before I get into charts and numbers, let me just be a little bit more explicit about the factors that I consider today. I assigned some labels because I wanted to look at three different portfolios, so I created three groups. And these three groups have some differences, so there is a reason for looking at three different groups. The first one, I call it trends. And here I'm just taking some pretty straightforward principles of factor investing and applying to major markets. So trends, also known in the industry as managed futures or CTAs, it's pretty straightforward as a factor strategy. It's about buying winners and sell losers. As simple as that. Now, the way that it's done is across major markets. So we are talking about equity market indices, commodities, foreign currencies, and government bonds. And typically through liquid derivatives like futures. The styles of trend is called in academia also time series momentum. And the idea of adding the time series in front of momentum is because, as I said before, is about buying winners and sell losers. So you could be 100% long, 100% short, or you could be 50-50. You just let the market drive you. And it's about really, riding the markets. Figure out where the trend is going and hoping the trends will keep going in that direction. So the type of bets that is implied by trend following strategies is about market timing. And I constructed a portfolio across these different markets that is meant to represent the average performance of a trend following strategy. The second type of factor strategy that I have in my study today here, they are called macro strategies. Exactly the type of strategy that Jim was referring to before. So the factors implied here are carry. So I'm looking for assets with high yields and assets with low yields. And I'm going to buy the ones with high yields and sell the one with low yields. And then value, straightforward. Look for assets that are deemed to be cheap, buy them. Find assets that are deemed to be expensive, sell them. We have our long-short portfolios. That's the factor. And lastly is the long-short equity factors. I suspect many of you might be familiar with these ones. I look at value, momentum, size, a couple of quality measures, and low volatility. And what I did, I just aggregated them and built a representative portfolio. So long story short, here we have basically 3 portfolios, and I'm going to be looking at how this portfolio perform across different market cycles. So the first type of cycles, if you allow me the definition, is very narrow and sharp. I'm very interested in stock market drawdowns and see how these factor strategy perform across this type of events. And what this slide is showing you, the main takeaways in the title. The title says, factor can offer a wonderful edge. And let me show you why that's the case. So first of all, what do we have in this chart? Here we have some dots. In the blue, I put together some benchmark indices, just as a point of reference. And forgive me, but in red, I constructed what is an advisor portfolio. I don't mean any of the advisors here today, of course. It's just meant to be a representative, reasonable combination of these different indices. Then what I did is, on the horizontal axis here, I computed the average annual excess returns since 1989 to 2018 of these indices. Then what do we have here on the horizontal axis? I just focused on those major drawdowns. Which ones? I actually picked the 5 largest drawdowns of the S&P since 1989, so 5 of them. And then I look at the returns, the monthly returns during those drawdowns. What you can see, it's pretty intuitive. So, well, first of all, the portfolios don't do well, except for if you have a little bit of bonds and duration, they can be about flat. The other observations that we have here is that, well, if you want average high excess returns, what you're going to see is that when the bad time comes, you're going to lose more money. Why? Because what's driving these different indices basically is beta. That's just beta. If you want higher average excess returns, you're deemed to do a little bit poorly when the bad times comes. Now, I have a few other dots here in this chart. Let me start with the yellow one, and that's just a fun fact that I added for myself. If you wonder what this is CHF over AUD is actually the Swiss francs against the US dollar. I'm from Switzerland, so I always plot the Swiss franc. I keep track of my wealth in Switzerland. The other reason is that actually the Swiss franc is a known safe haven currency. The Australian dollar is a known speculative currency. So I thought, okay, let me see how it integrates within these plots. And let's see how it fits within this narrative. And what we are seeing here is that the Swiss franc is indeed a safe haven. Actually works like an insurance. On average, it costs you 2% every year to invest in Swiss francs against US dollars. But when the bad time comes, the insurance pays off. You're going to make about 2%. That's the idea of insurance. In finance, what we will say is that, well, this is just a negative beta investment. You're buying insurance just by buying something as a negative beta, which is going to do very well when the stock market tanks. What are the outliers here? And that's one of my points here of this presentation. Well, we have 3 outliers here, and of course are these factors. We have the long-short equities, we have the trend, and we have the macro. What we can see here from the slide is a couple of things. Well, first of all, they are absolute return generators. You can see that you're earning positive average excess returns over time. And yet, they do quite well during really rough times for the market as a whole. What is saying that? It's saying that these average excess returns that you earn over time, they are not explained by beta. What drives these factors are other things. So we are kind of checking the boxes here, say, okay, this makes sense. What drives the factor strategies is not beta. We are indeed picking up on alternative source of returns. We are picking up on alternative risk premium, or people will call it alternative beta, exotic beta, smart beta. Is another way to think about it. But the key point is you can earn excess returns, and they also provide you a wonderful hedge during bad times, really bear markets. Why? Because it's not beta what drives the returns. All right, so if this was it, I would be done. I would say, okay, now you have to invest in this product. And today's talk is not about that. I say, okay, this is the rosy story. This is the positive case for these factors, but of course there is more to that. And we should be open and we should be honest about that. And I think that's a great way for us to really set our expectations right when we think about factor investing. And what this slide shows is that, yes, they are very good hedge during bad times, these factors, but a little bit of everything can happen anytime. And let me show it here. So what I did here, I tracked these portfolios, the trend, the macro, and the long-short equity. And then I look at when these portfolios gives you positive returns or negative returns. And then I compute the probability. But these two charts, I did another thing. I condition for the performance of the S&P. So here we have the good months for the S&P, and then I compute my probabilities. On the other chart on the right, we have bad months for the S&P. So when the S&P went down, and then I compute again the probability for these strategies to give you either positive returns or negative returns. What we are saying is the following. Well, trend and macro during good times for the S&P, well, they are more likely to do well than poorly. What about long-short equities? This is something that was hinted before by my colleague Johanni, is that actually what we are seeing here is that the odds for my representative long-short equity portfolio to do well or to do poorly during good times for the S&Ps are actually 50-50. On average, you're going to be 0. You have an equal chance to make money or lose money out of this factor. What about down months for the S&P? The chart on the right. Trend and macro, again, they're more likely to do well, but they can still do poorly. What about the long-short equity? Very likely to do well than poorly, but still there is the chance that it can do poorly, that you lose money. So, adding up, they're a great hedge against bear market, yet a little bit of everything can happen. That's a little bit depressing. So how can we kind of try to make sense out of this? How can we go beyond simply saying, well, it's just the distribution. You had a -2 sigma event. Well, that might not be that helpful. You want to know more why that's the case. What's the economics about potential underperformance? And let me give it a try. That's what I try to do with the next part of my presentation. And I'm going to be arguing that one potential explanation is not the only explanation. There are many elements that can explain the performance of factor strategies, but one potential explanation has to do with cyclical fluctuations in the equity premium in the stock market. And I'm very interested to figure out how this factor strategy performs across different market cycles. Unfortunately, there is no agreed definition of what the market cycle is, so I had to come up with one. Actually, I had to come up with 4. I wanted to figure out what are the bulls, the rebounds, the correction, and the bear markets. And since I'm lazy, I kind of wanted just to use an Excel spreadsheet. I figure, well, you know what, I just download the S&P 500 index returns, compute the monthly returns, and compute 2 variables. The first one is just the current month returns for the S&P, so 1 month returns. The second one are the 12 months returns, trailing 1 year returns for the S&P. And then what I do, well, I look at whether they're positive or negative. And then I cross these 2 variables. Very straightforward. And I say, well, if both they're up, I say this is a bull market. It's been going on for quite a while. It was a good month, and it's been a good month. It's been a good year. So I just call it a bull market. What about bear market is the opposite. We had negative returns over the year. We had negative returns this month. Well, that's a pretty bad time. I'm going to give it the label of bear. What about turning points? Well, those are intuitive. Let's say that we are coming from a good year, but we have a bad month all of a sudden. Well, I call that a correction. What about the opposite? We are coming from really a bad year, and all of a sudden we have a good month. I call that a rebound. Now, why going all through this? Why not just simply look at the 1 month returns? The idea is that if you look at, for instance, let me think about a month, May 2009. I think that was a very good month for the S&P. It was probably the first positive month after the major financial recession, the Lehman, and all of that. When we do our analysis, our statistical analysis, that would just show up as a good month. But that was a very special month. It was a good month after some really, really bad times. So it says that maybe something was special about that month, and your portfolio were positioned in a certain way. Those factors might have certain sensitivities. Instead, if you had a good month, let's say, in 2015, 2016, well, how special was that? Not really special. We have basically our long bull markets. So we want to keep track and make a difference, a distinction between these different type of positive outcome and negative outcome, depending on what the history is telling us. So, all right, I got this four definition, and I told you a story about this four definition, but do they actually line up with reasonable variables? So what in these slides I try to do here is to validate my choice of market cycles and their definitions. So first of all, I have here on the pie chart, I just show you the frequency of the cycles. What you're seeing that since, I think, 1971, 45% of the times we live what I call the bull market. Corrections are quite frequent, it's about 1/4 of the times. And bears and rebounds are fairly rare. So bear is about 13% of the sample, and 14% of the sample are rebounds. If you add up bulls and rebounds, you get 60% of the sample. So 60% of the times, actually, the stock market is going up. So most of the time, we live in good times. But these good times and these bad times can come in different shape and different forms. What about the macro variables? So here on the chart on the upper right, I'm showing you how the volatility changes and whether these volatility changes are statistically significant. So I'm interested about whether they're really meaningful in a statistical term, and across the four different phases. So I'm looking at volatility, the intra-month volatility of the S&P, basically similar to the VIX, within the bulls, correction, bear, and rebounds. And what we are seeing is that during bull markets, volatility tends to fall. Not in a very meaningful way, but it falls a little bit. When corrections comes, we see big spikes in volatility. Let's remember February 2018, when the VIX went from basically almost 8 to 25 or so. That's a good example of a correction. During bear markets, volatility rises still a little bit, but not as much. And then during rebounds, volatility tends to drop. Okay, check. This was a good match for my indicators. What about financial conditions? I have them here. So I got an index from the Federal Reserve. They compute an aggregate financial condition index. It includes also like real variables like balance sheets and stuff like that. And here I'm showing you whether these financial conditions are above their average or below their average. So if they are particularly good or particularly bad. And what we are seeing is that during bull times, financial conditions tends to be very good. During correction phases, they start to deteriorate. During bears, they are in bad shape, and rebounds, they're still in bad shape. So check. My definitions of correction, bull, and bear rebounds match in a reasonable way with financial conditions. Same thing, lastly, with output. What we are seeing here is that, again, output is above its potential level during bulls and corrections, and the economy tends to be a little bit slow to pick up things, so you're actually still riding very strong on the real side when you're in a correction. And finally, bears and rebounds, output drops dramatically. So check. This definition lines up well with all the macroeconomic variables. All right. So this is one of the key slides for today. What I do here is basically I show you the unconditional performance of my factors, trend, macro, long-short equities. I also added what I call the advisor portfolio, just a combination of those benchmark indices, a reasonable combination. And then I show you the conditional performance in annualized terms in bull markets, correction, bear, and rebounds. And the sample goes from 1971 to 2018. And a few takeaways here, a few important takeaways. Well, first of all, let's start with trend. If you know momentum, trend following, what it does is it does really well during bull and bears. We showed before in the slide when I show you during major drawdowns of the S&P, your trend following strategy is going to do great. Yes, the catch is it's not going to do great the other times. When? When we see corrections and also when we see rebounds. Why? Well, that makes sense. The name says it. Trend is about riding the wave, riding a trend. What are correction rebounds? They are turning points when risk appetite goes from risk on, risk off, or the other way around. So those are the times when your trend following strategies, managed futures, CTAs, all this whole universe are going to do poorly. What about macro? Macro is actually pretty impressive. Still does not so great during corrections, so you don't really beat cash during those times. The excess returns are about, statistically speaking, they're zero. Example of strategies that do really poorly within the macro space is like foreign currency carry trade, if you're familiar with that, buying currency with high yields, selling currency with low yields. those strategies are actually going to blow up during correction phases. When the volatility, when we see the VIX spiking up, they're going to struggle. What about long-short equity? Actually, long-short equity, the way that I consider here, that I designed here, is rock solid during bad times for the stock market. So it does really well during corrections and bears. Kind of flat during bull times. And again, if you look back at the experience of the last 15 years, and maybe you'll be looking at some equity deals, equity factors, this shouldn't be a total surprise. We see it here. What about rebounds? Actually, it struggles during rebounds. It doesn't do so well. So one of the lessons that I got from this table is that when we look at these factor strategies, the alternative factors, whatever names you want to assign to them, but we have these factors, and something that it's clear here is that when we have turning points in the markets, it's either a correction or rebound, that's when you're more likely to expect that your factors are not going to do so well. And that makes sense, because factors are about harvesting risk premium. And when you have turning points in the markets is when we see swings in risk premium, we see swings in risk appetites. The other thing that I will echo that Jim said before is that in finance, the only free lunch is truly diversification. So if you were to look at this table, you say, okay, let me pick the best one, or say, don't go there, let's do not go there. Diversification is always the best way to go. We never really truly know how things are going to work out afterwards out of sample. And the other thing, last thing I want to add about this table is that, hey, the advisor portfolio actually does really awesome the majority of the times. Let's see bulls and rebounds. This, as I said, is about 60% of the sample. So almost 2 times out of 3, the advisor portfolio is going to be looking really, really good. The downside is that the ways the market moves is asymmetric. Sometimes the bad times comes, and they can be really, really deep. They can look really, really awful. And that's why the factors then they come in and can kind of bail you out. But let me push a little bit forward this narrative about the bulls and the rebounds. And with this chart, what I did here, I updated the chart that I showed you before about the deep bear markets for the S&P. But instead of plotting those states here on this vertical axis here, what I'm showing you is the average returns during up month for the S&P. So I put together bulls and rebounds together in the chart. And then I'm showing you what this universe of assets or indices or portfolios are doing unconditionally, shown on the horizontal axis, and conditionally on those times on the vertical axis. And what we are seeing is that factor strategies, and this again, this is about 60% of the times we see this. 60% of the times this happens. We see that your factor strategies don't do as well. So I'm not saying they're doing poorly. Actually, this to me, that looks still very good. But hey, when beta does well, when beta shines, when the equity premium is really good, and I'm talking about these guys up here, everything else doesn't look great. And that's something that I heard many times. People say, well, the S&P was up this year by 15%, and yet hedge funds didn't do well. Yeah, no surprise. This chart is consistent with the narrative. And my point is, don't pretend them to necessarily shine exactly when the rest of your portfolio is already shining. We should just be happy with that. And my line here is, can you resist chasing performances during good times? So can you resist, can you stick with the strategy? Because this is not 100% of the sample. It's less than that. All right, so factor strategy and secular changes. So I have a few more minutes, and I want us to offer a few reflections of potential changes that we are seeing, the way the economy is working, and the macroeconomy, and potentially how market cycles have been changing as well. So first of all, my first observation is the great moderation is real. If you know, Rob is a frequent critic of the Fed, and I actually think the Fed has been doing a great job, so I'm at odds, and hey, we got some diversity of opinions, and one way to show how I think the central bank has been doing a great job, and in contrast also to what John said this morning, I will say we live in great times. I'm very young, so I'm just 35, but I will say I think things have been getting much better with respect to the past, and this chart shows it. This is one piece of evidence that shows that actually we live in some pretty good times in historical perspective. What I'm showing here is basically quarterly real GDP growth, so quarter over quarter real GDP growth, from 47 up to basically end of 2018. And I highlighted basically 2 periods. The first one goes up to 1989, and the second one goes from 1990 to the 2018. And what you can see is that the following. In yellow, the older period was highly volatile. We had a really massive volatility in the growth rate of the economy. Actually, the average growth rate was even higher, but the volatility was much higher. So these bars includes basically 90% of the sample. What happened around the 90s is not entirely clear. One of my stories, and that's why I pressed the Fed, and I think it has a lot to do with that, is volatility has been massively reduced. And we are seeing here, basically, volatility fell by half, basically. Can this have any impact on financial markets or any implication? Well, what I'm seeing here is that I went back and then I checked my cycles frequency. I said, okay, let me see if we see any change in the cycle frequencies. We have bull cycles here, and I tracked them, first of all, from 1971 to 1999 in the top, this pie chart, and in one in the bottom, I'm looking at 1990 to 2018. And what we are seeing is that the frequency of bull times has increased from 34% to 52%. What about corrections? The frequency of correction is actually still stable. The frequency of bears has been cut in half, and the frequency of rebounds almost cut in half. So one of the lessons here is that, what I learned is that the volatility of the economy has fallen dramatically. And so we also seen good times for the stock market. Indeed, recession are becoming less frequent, and just think about it. GDP is about 75% of GDP is consumption. Consumption is a major driver, of course, of profits of firms. So to the extent that the economy overall as a whole is less volatile, it means your profits are less volatile, dividends are less volatile. And we are seeing markets just going up with more persistence. And going back to the long-short equity strategy, if you remember, doesn't do so well during bull phases. Well, we are seeing bull phases becoming a little bit more frequent. What about bear markets, though? And here is cautionary tale. What can we say about bear markets? Are they looking any different? Something that I noticed is that's very easy to notice, that the 2001 recession or market correction was spectacular. The great financial recession, actually, in 2008, 2009, was quote-unquote spectacular, if you allow me the term. Magnitude-wise, was very large. So what I did, I actually looked at the performance of the S&P across these cycles, but I also distinguished the two subsamples, 71, 89, and 1990, 2018. And what we can see is that the performance of the S&P across market cycle has been fairly stable, except for bear markets. We are seeing that the average analyzed returns during bear markets of the S&P went from minus 44% to minus 64%. So bear markets have kind of become deeper, which makes the case, hey, do we still need factors? To the extent they provide you a hedge against bear markets, I say yes, and especially because maybe bear markets are becoming deeper. Less frequent, but a little bit more violent. All right, so these are my last slides with numbers. You might wonder, have the hedging properties of factor strategies changed over time, maybe because exactly we are seeing some changes in the frequency of these cycles. And here I'm just doing a check. I'm looking across the two subsamples. I'm looking at the performance of the factor strategies in bulls, correction, bear, rebound phases. And the main conclusion is no. Actually, the performance during bear market has spiked, especially for trend and long-short equity, which in part can be related to the fact that these bear markets are becoming a little bit deeper than they used to be. But the bottom line is that your factor strategies are great, still great absolute generatable returns, and they're still offering you a great hedge. All right, let me offer a few concluding remarks. I had three things here today to share with you, and hopefully you can bring with you, is that market cycles matter. And factors are meant to be diversifiers, but diversification is not a perfect hedge, and we need to be mindful of that. So how can we make sense of performance? How can we manage our expectations within the space? Well, I suggested a few things. The first one is to remember that factor strategy tends to be a great hedge during really bad times. And be aware of that, I think, is very important. If bad times are rare, when the bad times comes, you will wish that you had some of these factors in your portfolio. The second point that I had is sensitivity to turning points can be important. So let's look at 2018. Some of the hedge fund industry, if you've been reading, some of them have been struggling. It wasn't a great year. Arguably, 2018 was a correction year. Volatility spiked. We had swings in the risk appetite of investors. Indeed, this factor didn't do so well. And Lastly, structural changes can help explaining some of the performance shortfalls. I made a point about some of the equity factors that don't do so great during bull times. But one of my invitations here is really to resist performance chasing and remember that the hedging probability factors, they have not really changed over time.